G'day everyone, welcome back to Pete's Investing and Trading channel. Today we're trading the CCI14 strategy with average down, comparing the 5% gain and 5% decline versus a strategy of closing price crossing over the simple moving average 20 with a 5% gain to exit. And we compare and see which strategy is more efficient to trade. Don't forget to review our playlist which covers trading strategies, share price and indices reviews, and this video will be covered in the strategies playlist. The strategy plays is where we cover the simple trading strategy, the average down process, and some money management ideas. We're not offering financial advice, but rather this is an educational series to help you make better trading decisions. Let's get started. So first, I'm about to demonstrate the entry and exit strategy with two scenarios. The first scenario is where we enter the trade when the commodity channel index 14 period crosses over the zero line. We exit the trade when the closing price gains at least 5%. Now we average down when the close day declines by at least 5% and the CCI14 breaks above the zero line. We then buy double the quantity of shares from the previous trade we made. We keep pairing that strategy with the second strategy, which demonstrates an entry when the closing price crosses over the simple moving average 20. We exit when the price gains at least 5% and the close breaks down through the simple moving average 20. And we average down when the share price drops by at least 5% and close is less than the average price. Now when we buy an average down, we buy the same number of shares as the previous, so we're not doubling up on the shares, and I'll explain to that why when we see the results. So let's look at some charts. First we'll look at the Commonwealth Bank of Australia, and I just want to quickly demonstrate what we're looking at in terms of the overall picture for all these charts. This is a profitability for the close greater than a simple moving average 20 profitability. This is obviously the price chart. This is a profitability chart of the 5% gain and 5% decline. And these stepped charts indicate the number of trades we've made. So in this little example, we've made 2 trades, one average down there. When it's a single block like that, it means we entered and exited the trade once. As you can see up here, we've entered multiple times. We entered once, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, about 11 or 12 times we entered. So if we're trading $2,000 lots in each of these, we've entered multiple times. In this one, we're doubling up on the shares every time we average down. In this one, we're adding the same number of shares. So let me just drill in and give you an example of the entry and exit for both the trades we're looking at. And I'll cover these little examples, 1, 2, 3 examples here. So again, this one we're looking at the percent gain of 5%. We exit the trade, and a 5% decline if the price drops against us. So you can see here in this one, we enter the trade there, the price goes against us, and that rule there I've drawn is 5.75%, so it's actually dropped below that. Now when we enter the trade there, we'll notice the CCI14 breaks above zero. We don't enter it again until the CCI breaks above zero, which it has there. That's where we enter an average down. So that tells you there we entered the first lot of shares there and a second lot of shares there. And the trade exits, those 2 trades are exited there because we've broken it from there to there. The average price would have been somewhere in there, and that would have been our 5% gain, so we exit the trade. And this just shows you another example of the same program, entering the trade there and exiting there when it's broken above 5%. You can see there that rule has been drawn. That was 5.5%, so the close broke above that on the close of the day, so we exit the trade. That's why it was a single trade. Now, the price did continue to go up, but let's not be greedy. This is our strategy, and I've tested 5% gain versus a 10% gain and so on. And we get in and out of trades more efficiently and more profitably with a smaller gain and exit. This one up here demonstrates the close entry when it's greater than the moving average 20. So a bit hard to see there, but the close breaks above this red blue line is the simple moving average 20. The close breaks above it. We're not looking at the CCI in this example. We're only looking when the close breaks above the moving average 20. You can see back here, the red line here, it broke above moving average 20, enter the trade, and exit it when the moving average 20, when the close breaks below the moving average 20. That's when that trade exited. We entered another lot of shares there. Close breaks above the moving average 20. Now the price went against us. We entered another lot of shares there when it breaks below 5% again. We entered another lot here. Keep going. Now you notice this one breaks again and closes when it's reached at least 5% gain, and the close is less than the moving average 20. So we exit the trade there. Now you'll notice these ones are left in the trade longer, for longer periods, like this example here. This one entered and exited shorter. This one stayed in the trade longer. But you will notice as well, if I zoom out, you'll notice the percentage gain of 5%, decline 5%. This is our favoured program. Generated 14,604. The period getting from 2007. This one generated 12,428. And I'll show you the summary of results in the table in a minute. Now the reason I've gone back to 2007, you'll notice here, I want to take in the effect of the GFC. And also the effect of COVID, back here, the start of 2020, and more recently the effect of the Ukraine war. So I'll go through some other charts very quickly, demonstrate the effects of how the charts have performed. Let's look at BHP Australia. Again, very quickly, you'll see the GFC effect. This mining company, BHP, went all over the place for some time, went a bit of a pretty big decline there as well. You'll see here the averaging down was minimal compared to this close greater than simple moving average 20. There was another big decline here. Again, minimal trades entered for the percentage of 5% decline in gain versus the moving average 20 approach. And then more recently, the Ukraine war, and smaller trades entered there and exited. But again, 16,700 for our preferred program versus 9,937 for the moving average 20 program. I'll show you a couple of others. Johnson & Johnson in the US. This had a steeper increase in share price. Again, more of an impact in terms of the averaging down during the GFC. For the moving average 20 versus the percentage 5% gain and 5% decline, which is our favourite program. And this one just tipped over the edge with 5,964 for our program versus 5,888 for the moving average 20 program. I'll show you another couple. JP Morgan. You can see there a big decline over COVID, somewhat of a slight decline during the GFC. But again, you can see there a bigger impact in terms of averaging down versus our program. I'll just show you one more in terms of share price action. This is Caterpillar. Again, bigger impact, close greater than a moving average 20 on entry versus the CCI14 entry strategy. So let's quickly go to our summary table. Before we do that, let's go through some what we covered. We looked at the entry strategy, the exit strategy. Now with the entry strategy, we're covering a simple trading strategy with the probability of a price increasing from an entry point. The exit strategy, there are many videos which show you how to enter a trade, but most of them don't clearly explain how to exit the trade profitably. In this video, we show you an effective way of exiting the trade profitably. Note also we don't use stop losses. It's a sure way of minimising returns and more often than not losing money. The average down strategy, instead of stop losses, we use the average down approach with some disciplined money management to show you how to exit the trade effectively and profitably. This approach has been backtested on stocks, CFD indices, commodities and forex currencies. Again, the key here is good money management. And today we'll be trading only buying stocks which are owned by funds who own outright. We show the calculated funds required when following the drawdown approach, and I'll show you those results in a minute in the trading template we demonstrated. And also on average, we show you the returns you would have generated had you traded $2,000 loss per trade. We don't show the returns within dividends. Again, so any dividends you would have received would be a bonus on top of the average return. Some of my investing rules: buy proven blue chip stocks only, avoid speculative stocks. This ensures a probability of the shares that the company you're buying has had a good track record and more likely potential future growth. Buy stocks which pay dividends. You should do a quick search on the stocks before buying to ensure it recently paid a dividend or about to. This is a good indicator that the company has future potential of growth. If the company recently, that is the last 6 to 12 months beforehand, stopped paying dividends, it may be a sign their growth potential may be challenged for whatever reasons. Don't short positions, go long only. Do not trade on news. Price is already factored in the share price. So this is the results of our CCI14 breaking above zero strategy. Note we're trading $2,000 lots per trade and beginning backtesting in January 2007, which covers the GFC, COVID and the Ukraine downturns. We show total revenue per stock, the number of times we had averaged down, and the total drawdown effect, that is money, we need to have in our account. Then a monthly average revenue based on the number of months from 2007 until today. And these are results of the backtesting for the close breaking above the moving average 20 approach with a 5% gain to exit the trade, with a decline of 5% to average down. Lastly, this table summarises the two backtested results. Note the revenue generated by each, but especially the drawdown required. The profit over drawdown percentage is our key indicator for efficiency. So in this example, the higher the efficiency, the better. So in other words, we gain more profit and less drawdown, hence the higher profit over drawdown efficiency. Don't forget to click the subscribe button, the notification bell and the like button. And happy investing, and see you in the next video.